Thank you for joining today's Technology Transactions webinar. Our program today will focus on Software as a Service, what you need to know. My name is Brad Peterson, and I'm delighted to introduce today's program. I'm a partner in Mayer Brown's Chicago office and lead our firm's Technology Transactions practice. Our Technology Transactions practice includes about 50 lawyers worldwide who have done over $200 billion of data, digital, outsourcing, and software transactions. And this is also a key data privacy topic. So we also have with us Lei Shen from our cybersecurity and data privacy practice, who also practices in tech transactions. Our cybersecurity and data privacy practice comprises more than 50 lawyers worldwide from disciplines that include litigation, regulatory, corporate, technology transactions, government affairs and global trade, IP, enforcement, and employment. I'll cover a few administrative matters, then we'll get started with the formal program. First, at the bottom of the screen, you will notice that there are multiple application widgets that you can use. Each of the widgets is resizable and movable, so feel free to move them around to get the most out of your desktop space. You can also expand your slide area or maximize it to get the full screen by clicking the arrows in the top right corner. Today's program is being streamed through your computer, so there is no dial-in number. For best audio quality, please make sure your computer speakers or your headset are turned on and the volume is up so you can hear the presenters. For the best viewing experience, we recommend using a wired internet connection, preferably with Chrome or Firefox browsers, and closing any programs or browser sessions running in the background that could cause issues. Some networks cause slides to advance more slowly, so logging off VPN, for example, might be good. If your slides are behind, pushing F5 on the keyboard should refresh the page. You can find additional answers to some common technical questions with the Help widget located at the bottom of the screen. During today's presentation, you will be provided with an alphanumeric code for CLE. If you are applying for CLA credit, you will need to record that code on the virtual sign-in sheet that you received by email with the connection details. You can also find a copy of the virtual sign-in sheet in the resource list widget, which is on your screen, and it's the CLA affirmation form. The directions for returning the CLA affirmation form to us are on that sheet, and we will read that code in the middle of the presentation and again at the end in compliance with local law. Please note, we've made the event evaluation form and presentation deck available in the resource widget for your convenience. Also, the webinar is being recorded as we normally do, and in a day or two we will send you an email with a link which you can use to listen to the webinar again or share it with your colleagues. The recording will also be posted on our website. So with that, I'm pleased to have the opportunity to introduce my co-presenters, Lei Shen and Rohith George. Lei is a partner in both the cybersecurity and data privacy practice and in the technology practice, and she works at the intersection of those, specializing in transactional data privacy and security issues, including those raised by software as a service or SaaS agreements. She also advises on e-commerce issues such as electronic contracting and signatures, and issues concerning mobile privacy and emerging technologies such as telematics. And those will be particularly relevant on customer-facing SaaS, which will be a topic that Rohith George will cover. Rohith is also a partner in the Technology Transactions practice, but Rohith is located in our Palo Alto office. He focuses on helping companies negotiate complex commercial arrangements involving mission-critical technologies, including major business transformations. And he has exceptional recent experience in customer-facing SaaS transactions, what we often call platform deals, and we've asked him to talk about those during his time with us today. So with that, I'd like to do the introductory portion of our presentation, which is called Key Contracting Issues, and that'll be followed by Rohith's description of customer-facing SaaS issues, those issues that go beyond the general SaaS contracting issues, and then finally, Lei Shen will talk about privacy and data security issues. So, for key commercial contracting issues, The way to start to understand the commercial contracting issues, the issues between the buyer and seller for any technology contract, is to start by understanding the technology. So let's take a step back to talk about cloud computing. SaaS is a form of cloud computing. And what we have here is what seems to have become the canonical definition of cloud computing, the definition from the National Institute of Standards and Technology. NIST said that cloud computing is an on-demand self-service platform where a customer can unilaterally provision computing capabilities without additional human interaction with the service provider. It's supported by broad network access, generally over the public internet, and accessible through a variety of devices, mobile phones, tablets, laptops, workstations, and so forth. A third piece is that there's a pool of shared resources. The service providers, the cloud computing resources, such as memory, bandwidth, storage, are provisioned to serve multiple customers, which provides economies of scale, and different physical and virtual resources are dynamically assigned and reassigned. This was made possible by the confluence of two technology developments that have been going on for a very long time. One was grid computing, the ability to get a huge number of small devices working together, generally Wintel servers, and application virtualization, allowing applications to run on any machine. Rapid elasticity, the ability to rapidly scale up. So for example, if your application is working really well, you're able to get as much computing power as you need. And then finally, it's a measured service. It's metered by the amount that it's actually used. Within that idea of cloud computing, we've introduced three major distinctions, and they're defined by what people have been calling the stack. If you imagine that computers have a network layer at the bottom, and on the network there are storage units and data storage units, and there are servers, data processing units. The servers run operating systems that connect to the storage unit and the network. And on top of those operating systems, you can run applications, and the applications can process data. In IaaS, infrastructure as a service, the cloud provider offers the network, the storage, and the server. And in platform as a service, the provider might also offer the operating system. So instead of just having what's called a hypervisor upon which you could load an operating system, the operating system and many tools might be there. And in software as a service, the SaaS provider actually runs application software, the sort of software that users interact with directly and processes production data. Now, a twist on this lately, this is a chart that we've been using for 10 years, but one of the things we're seeing now is that now almost every SaaS cloud service is built on some sort of a IaaS, or infrastructure as a service cloud service. So the hyperscale cloud providers, Amazon Web Services, International Business Machines Corporation, Google Cloud Platform, Microsoft Azure, and other hyperscale cloud providers form the basis for the SaaS cloud. And that's important because it limits the flexibility of the SaaS provider to modify its technology. So why is SaaS growing so rapidly? Many reasons. First, it's already built. Our customers are now looking for rapid digital transformation because companies are facing digital disruption. They need to move to customer-friendly cloud platforms at a speed far faster than they can actually build it. Second, cost. Right now, being a SaaS provider is a very well-funded activity. There's tremendous amounts of venture capital going into building great technology. And if you're a customer who'd like to, facing a build versus buy choice, it's at this point often far cheaper to buy a cloud service instead of build something on your own technology. Third, scalability. Scalability is the techie word for if things go well and you need a lot more storage or a lot more computing power, can you get it quickly? And can that grow almost to infinity? And the cloud model works very well with that. Ease, having the SaaS provider do the tech work makes it much easier to work. And finally, what's driving capability now, what's driving the transformational change now is the rapid increases in capability. We are seeing now SaaS platforms being used for critical systems like enterprise resource planning systems, and they're also being used as the basis for technologies like AI and blockchain. And because those technologies are built on the cloud, they are attracting more and more of spend. So at Mayer Brown, we're often seeing our clients saying that it's a goal to move most of their work to cloud platforms of one sort or another, including SaaS. As the basics, how are SaaS deals structured? I think there are probably 6 primary elements of a SaaS transaction. The first, the SaaS provider agrees to provide a service as described on its site. SaaS is a one-to-many model. It's a configured, not a customized model, and it's generally an evolving model. So the promise to deliver is often based on a description which is behind a link which may change. Similarly, the customer's use is limited, and that may be limited through policies under links. So the customer faces not only the limitations that it may have because it's not buying some level of service, but also limitations that may be viewed only under links. This introduces a new contract management and governance challenge. Third, this is not a software license. The customer does not have rights to the software under normal conditions. There may be a springing software license under abnormal conditions, but generally it's not a license, it's a right to receive services from a digital platform. Fourth, generally, the SaaS provider agrees that the customer owns its data that it stores on the systems, and there is, of course, a question about the data being created on those systems. The pricing is generally based on capacity or usage in some form, and the provider's liability is limited, generally with some sort of a waiver of indirect damages and some sort of a cap or a series of caps on liabilities. So, if you're negotiating a software as a service deal, what are the critical issues? Well, for key commercial issues, number 1, use and users. What rights do you have to use it? And that might be, where can you use the platform, what countries, what jurisdictions, for what purposes can you use it, who are the authorized users at your organization. You may have the right to log 10 people in, 100 people in. When can you use it? What can you use it for? And so forth. We are finding now that as SaaS deals move from being almost science projects in one part of an organization to being global mission-critical platforms, our clients who signed up on early SaaS deals wish they had obtained the rights to use the SaaS platform for their broader enterprise, perhaps for the companies that they collaborate with, customers and suppliers, for their divested companies, and so forth. Also, consider as you're looking at use rights, not only use rights to the parts of the suite that you might want now, but new parts of the suite that are developed. And that's particularly true because SaaS providers often have the right to move functionality through those links from one product to another, and to transform their offering even as you're using it. Another emerging issue that we're seeing more often now as SaaS platforms are being integrated at the front end is that the use of a SaaS platform might be considered indirect use when using SaaS with other systems. So if you have an ERP system, for example, and your ERP system limits the number of users, and you connect the SaaS platform to the ERP system, then the users of the SaaS platform might arguably be users of that underlying ERP system. That can prove to be expensive. So, first commercial issue, use and users. Second issue, pricing. Pricing metrics, as I said, are generally based on some sort of volumes: the number of users, the number of transactions, the number of records in storage, the types of use. The SaaS provider often will have the right to change pricing. And if that's true, think about minimum notice requirements, limitations on increases, and so forth. These rights to change pricing are not consequential if the SaaS provider is offering a convenient solution that you can switch from if the price gets too high. But in today's environment, if you're moving to a mission-critical system that will be difficult to move away from, be cautious on what might happen in price. Also, be cautious on minimum revenue commitments. And the most common one we see is a minimum revenue commitment which is set based on past usage. So while the system is scalable and it can easily be scaled up and down technically, the pricing may only scale up, and you may find yourself paying for your peak usage as opposed to your actual usage. And then finally, consider closely charges for additional services, integration services, for example, that may be required to make effective use of the SaaS platform. As a third key commercial issue, operational requirements. If the SaaS provider has retained the right to make changes to its platform and to continue to innovate, consider first, are there minimum functional requirements that you may need? If a customer is building upon a SaaS platform and will leverage that from going forward, there may be some minimums that you would not want to build on a platform which is unstable in those areas. If there are integration points, the customer may reasonably be asking for advance notice on any disruptive change. For example, if the APIs might change and the customer might need to rewrite its own software or get other SaaS providers to rewrite to reconfigure their software, it would be prudent to have as much advance notice as is needed. And finally, service level requirements and financial incentives for performance. Within the cloud space, it's very common, particularly on those legacy cloud transactions that were not critical, and for consumer-oriented cloud, to have almost no potential liability for a cloud provider. However, if the customer is relying on the cloud provider and it needs to be able to trust that cloud provider, having a meaningful financial incentive may help to reduce the risk to the customer that the cloud provider will simply change its strategy and end up not providing the service that's required. Next one on operational governance rights. Cloud providers would prefer, and it's almost a part of cloud, to orchestrate it such that everything can be done through a digital interface. That may work well, but for a critical system, having the right to actually have conversations, to do the audits that your regulators might require, to have the information rights that you may need to that the customer may need to properly manage and govern the arrangement may be critical. And then finally, continuity. Many cloud arrangements, including the IaaS platforms that SaaS is built on, include a right by the provider to suspend or terminate services. The termination may be because of a desire to innovate, or it may be because of a threat to the network. Suspensions may be due to bad acts by the SaaS provider or by the customer, but the goal there, as much as possible, is to limit potential disruption to the customer organization when you're negotiating from the customer side. Understanding that from the supplier side, the suppliers need to limit risk to their platform and to be able to move flexibly to introduce new services. Next, disaster recovery and business continuity. Often this is handled in a weak way, or by saying the infrastructure as a service provider provides that. However, it's not a simple or an easy question whether a SaaS platform is able to sustain itself against a technological blow. Interestingly, the financial regulators are often leading in these areas. And 10 years ago, the financial regulators put forth a great deal of guidance, including on the importance of disaster recovery and business continuity. So the guidance has long been there, but in a financial institution letter on April 2, 2019, so a couple of months ago, the FDIC stated that recent FDIC examination findings noted that some financial institution contracts with technology service providers lack sufficient detail regarding two areas, business continuity and incident response. They've called those out specifically after a decade of relative silence, and we would guess that other regulators will also be equally interested. And finally, post-termination assistance. If you are disengaging, you have to get at minimum, your data back. You may need other assistance. And the final area on key commercial issues, legal issues, we've noted many times the provider's right to change the service. The provider, in some cases, also has the right to change contract terms by changing its policies and its service terms. This may mean that although the pricing doesn't change and the customer's level of commitment and need don't change, the contract does change. Consider customers limiting that. Second, consider limiting the transfer of controlled items across national borders. Cloud computing platforms, the less expensive approach is to do a global platform and allow work to be spread globally. Imposing national borders does impose cost on the cloud provider, and it may require specific legal provisions. A third example, in some SaaS platforms, the provider may be interested in using the customer data, and customers are, of course, allergic to that idea, so it may be presented subtly, like the provider will have a right to use the data processed as part of the SaaS platform to improve our services or to provide innovation or something of that sort that sounds good. But the provider's ability to use the customer's data raises a host of issues. Providers' use of competitively sensitive customer data may raise antitrust issues. The right to, if the data is trade secret data, it may limit your trade secret rights. If the data is other intellectual property rights, it may let the cat out of the bag in some way. And the customer could find itself liable for these uses of the customer data. In addition, of course, customer data has value, and if the customer is granting a provider the right to use that data, the customer should be thoughtful about capturing some of that value. Legal issue on representations and warranties. A common area for dispute is whether there should be reps and warranties about things like the quality of the performance and the quality of the people. Although the service is digitally delivered, it's people who make the difference. So traditional warranties in those areas are appropriate. And then, as with any commercial contract, indemnities, limitations of liability, and termination clauses are critical. And with that, I'd like to turn it over to Rohit to talk about the next issue, which is what else happens when you move from a back-office SaaS arrangement to a customer-facing SaaS arrangement.
Thank you, Brad. So, as Brad mentioned, he's been talking about some of the key contracting issues in SaaS deals generally, but as a SaaS solution that you're contracting for ends up being customer-facing, there are some unique issues that I'd like to talk about. So, every new technology probably goes through a pretty similar adoption pattern. At first, it's new, it's untested, and therefore it's a high risk. And most companies are not going to dive headfirst into such a new and untested technology, not going to immediately use it in connection with their core business or for their core products. So usually you start with your back office functions to try to cut costs, find efficiencies, keep your risks low. And that's essentially what this slide illustrates. You have a SaaS provider providing a solution. Let's say it's a CRM solution, customer relationship management. The company then uses that CRM solution to improve the way it delivers its products and its services to its customers. But at the end of the day, the customer interfaces with the company, not with the SaaS provider. And this has been the type of deal that many of your companies have been doing for the past 10 to 15 years. But what we've seen, though, is that as companies have grown more comfortable with with SaaS and with SaaS solutions and with cloud computing and cloud technology, as the risks and the benefits have become more well understood, what we're seeing is companies are willing to contract for SaaS solutions that, instead of sitting in the back office, actually sit more in the front office. So, what does that look like? It looks something like this, right? So this diagram, a company partners with a SaaS provider, and for the sake of providing an example, let's say it's a bank partnering with a fintech for a lending platform, and that could be a white labeled solution with the bank's own branding, perhaps not. Regardless, the SaaS platform is then deployed to interface directly with customers in order to acquire customer information, make a loan decision, and ultimately sell the bank's loan products and services to customers. And that's the top part of this diagram. The bottom part of the diagram, in some cases, the provider might also sell its own products to the customer. So in the example I mentioned, a customer who's turned down for a bank's loan on that SaaS platform may be given the opportunity to immediately apply for a loan directly from the fintech that's providing the platform. So as you can see, there are at least two critical differences here between what we see here on this slide and what we saw on the last slide. The first is that the provider is obviously interacting directly with the company's customers, and second, the provider is dealing with the company's core business, with its core products, and the impact of those differences on your contracting are what we'd like to discuss today. But first, to make sure we're on the same page, I thought we'd list some examples of some customer-facing SaaS deals that we've been seeing lately. As mentioned in my previous example, we're seeing multiple deals where a traditional bank white labels a fintech's platform, lending platform, or enters into some type of powered by arrangements. In some cases, we've also seen banks participating in multi-lender platforms where the bank's products are offered alongside other lenders' products in a marketplace, in a SaaS marketplace. And we're seeing kind of the same thing with insurance companies and insurance product marketplaces as well. But switching industries, the recent Murphy versus NCAA Supreme Court decision actually paved the way for legalized online casino gaming and sports wagering in the U.S. As you all may be aware. This has, in our experience and with our clients, generated quite a bit of momentum for casinos to enter into online gaming platform agreements with service providers in order to take advantage of this new market. Another example is in-vehicle telematics contracts between automotive manufacturers and service providers to allow customers of the manufacturer to interact with and interface with a SaaS platform for in-vehicle services. And finally, there have been an increasing number of fast food, fast casual chains, restaurant chains that we've worked with, partnering on either global or regional scales with food delivery platforms like Postmates or Uber Eats or DoorDash. But as you can see, this is just a snapshot of a trend we're seeing across many industries. So the question really is, as companies are partnering with providers who are offering these customer-facing SaaS platforms, what issues should be top of mind? So the first kind of set of key issues in this context is around scope, pricing, and SLAs. Like any technology deal, you ultimately want a good service description, but here in this context, you may want to get more prescriptive when it comes to customer interactions. For example, you may want detailed customer journey specifications for how the platform will operate, how a mobile app will operate, how the customer will journey through those apps depending on their selections. You may want to carefully script all the messages that are sent to customers, agreeing upon call center playbooks and scripts relating to issues with the platform itself. And then pricing is also very different from a back office SaaS deal. In a back office deal, the usual goal is to keep the charges low and predictable. In a customer-facing SaaS deal, you're more likely to have incentive-based pricing with shared upside. Both parties would then have an incentive to drive business results. If the SaaS provider is succeeding, the company is succeeding as well. Both are making more money through the contract. So the bigger concern here actually may be that you will want to ensure controls are in place to ensure the provider has the same goals while having the same kind of guidelines and ethical guidelines that you would want to drive to those goals. And then finally, for service levels, they're generally in a customer-facing deal, obviously more focused on customer experience. So they measure things like speed of platform execution, call center metrics, speed to resolve inquiries and complaints, in addition to the traditional cloud SLAs like availability and uptime. The next key issue in this context is about control over the platform. And when can the provider when can the provider change the platform without the company's approval? And this is an issue in any SaaS deal, and Brad mentioned it and touched on it. All SaaS providers, expect to make changes to their products as their platforms evolve, and they, expect the flexibility to do so without having to obtain client approval in every instance. So in a back office deal, as Brad mentioned, you protect yourself by requiring advance notice, by limiting material adverse changes, and then keeping a right to terminate as a last resort. But however, where the platform is going to be interfacing directly with your customers and perhaps using your trademarks and your branding, you may consider requiring approval rights over, changes to specific aspects of the platform. For example, we talked about the customer journey requirements on the previous slide. Those may be very critical to you, and they may have not just customer experience implications, but also regulatory implications. You may consider restricting changes to the platform that affect the customer journey through, as you've agreed to with the service provider or with the SaaS provider. And to flip the script, on the other hand, when can the company demand changes from the provider to the platform? And given that this, customer-facing platform may involve your core business, your core products, it goes without saying that the company should build in rights to require changes in order to comply with laws, in order to comply with regulatory guidance, in order to comply with perhaps even changing enforcement trends. Because while back office platforms do not often trigger significant regulatory risk, front office platforms are the opposite, right? So if you're a casino partnering with a SaaS company to offer online sports wagering, and a change in laws then requires additional precautions about age verification, then you need the ability to push down that change to the platform to then impose or take on the necessary additional processes to ensure compliance with that particular law. In addition, there should also be rights to make mandatory changes related to the actual products and services that are being provided through the SaaS platform. So that may be your underwriting standards, your credit policies in the fintech or the bank example. In another example, if you're an insurance company and you're partnering with a SaaS provider to provide, instant answer life insurance, you should be free to modify what's collected as part of that application for that life product. It shouldn't be subject to any mutual agreement. So you'll want to ensure that you have the right to impose changes relating to your products and your services that you're actually providing through the platform as well. The next key issue is around customer complaint handling, which is unique to these customer-facing deals. And obviously it's important in a customer-facing deal because direct customer contact by the provider magnifies any performance issues with the platform itself. And if the platform especially is white-labeled or co-labeled with your brand, if there's a problem, your customers and regulators are going to blame you. So, for example, any loan origination or servicing issues with lending platform, those can easily result in angry customers, regulatory scrutiny. Similarly, in the casino platform example, if it's not paying out your customers' winnings for some reason due to a performance issue, you're going to have reputational, legal, regulatory issues there as well. So with all this as a backdrop, the provider may find itself receiving complaints directly from your customers or your regulators. And for operational simplicity, you may agree that the provider should handle most of those complaints and then route the most sensitive ones back to you, the company. So the question is, the two parties, do they agree that the provider follows the customers or the company's complaint handling processes, or is it the provider's complaint handling process that are followed? There's friction there, obviously, because if the company is one that is subject to consumer protection regulations, it will likely have more robust complaint handling processes than the provider. which will have standardized ones for many of its clients. So ultimately, you'll need to verify that whatever procedures are used are at least consistent with your internal complaint handling procedures, with the laws applicable to you, the company, in order to ensure that this doesn't become a major issue. And then moving on to compliance with laws more broadly, this is, you'll need to make sure that the SaaS platform complies with all laws that apply to your company when the provider is acting on your behalf. So your company will likely be liable for any non-compliance caused by the SaaS platform, and this is obviously very important for highly regulated industries like insurance, healthcare, financial services, transportation. So the key issue here is that from a provider's perspective, the provider is familiar with laws that are applicable to it as a technology company, and it will try to narrow its obligations for compliance to those laws that are applicable to it in the provision of the services and the provision of the platform. Unfortunately, that universe of laws is generally small because they aren't subject to the sector-specific laws that apply to the company. So this is another area that can be different from a back-office SaaS deal because there are a whole host of consumer protection laws, for example, that the customer-facing deal will have to address that may not be implicated by a back-office deal. So ECOA, Equal Credit Opportunity Act, BICRA, UDAP, these are all laws that your typical tech company may not be well versed in unless they're providing services in that particular industry or field. So one typical compromise is to accept the provider's position that they will comply with laws that are applicable to or to them in the provision of their services, but add a couple of things. First, the provider would be responsible for violation of laws that result from their breach of the agreement. Another addition would be that the provider is responsible for their failure to follow your written instructions regarding your laws. Obviously, you're best situated to understand and interpret the company is best situated to understand and interpret company-specific laws or industry-specific laws, and so it may be in the best position to instruct the provider on what it needs to comply with. Another compliance area that may need special attention for a customer-facing SaaS deal is antitrust. So if you're, for example, on a marketplace SaaS platform, are there appropriate protections in place to ensure that no participant is actually provided competitively sensitive information about the other participants, whether directly or indirectly? And if that is the case, it may be harder to defend against any allegation of collusion. And this can easily become an issue if you have, for example, a platform. Let's go back to our fintech lending platform example with multiple lenders that are carving up the market through routing certain attributes of certain customers to certain banks while routing others to other lenders, essentially. So this becomes an issue that requires antitrust review. Similarly, if you're a bank that's white labeling a fintech lending platform, as we said, you may want contract provisions that prevent that the SaaS provider, from soliciting your customers directly for other products and services. But if you do take that approach, you also need to make sure that you don't draw those restrictions too tightly. So your customers may independently contact the fintech about a different credit product, and you don't want your contract to prevent that provider from considering that loan application because that may be deemed to be anti-competitive behavior. So moral of the story here, involve your antitrust counsel early on, avoiding the landmines that might create any appearance of collusive or anti-competitive activity. Another thorny issue in customer-facing SaaS deals can be around intellectual property. In any customer-facing SaaS deal, it's likely that you'll have your trademarks and your branding involved. And assuming that is the case, obviously you'll need to reserve quality control and approval rights over the SaaS provider's use of those trademarks and branding. And in addition, the provider actually obviously must comply with your branding guidelines as they change from time to time. And that hopefully shouldn't be too controversial, but what is sometimes more controversial is regarding data rights. And in some respects, this issue is not different than it is for any SaaS deal, as Brad talked about. The company generally wants to own data that is generated by its use of the platform, and the provider generally wants to be able to use that data to improve its services. However, it's worth pointing out that the type of data collected through a customer-facing SaaS platform has the potential to be even more sensitive than the data collected through a back-office SaaS platform. So, and that's not only in terms of personal, customer data that's collected, but also in terms of what that information and that data can reveal about your business. So, it's important to consider this when granting rights to the SaaS provider to use that data, and as Brad pointed out, to appropriately tailor that grant to the deal. Another big issue can be developed IP ownership, because in traditional back office agreements, you're probably not very concerned with developed IP ownership because you aren't outsourcing delivery of your core functions or your core products. But in a customer-facing SaaS agreement, you may be integrating some of your core products and related IP with the provider's SaaS platform. So who owns developed IP that contains both party sensitive IP, and is it possible to untangle that at termination? So, in the fintech lending platform example, the developed IP may combine the fintech's fraud model and the bank's underwriting criteria or credit policies. And if there are practical challenges in separating that combined IP on termination, there are a couple things you could do. You could decide that both parties have ongoing rights to use it. You could decide, if that's not acceptable, that the developed combined IP has to be destroyed upon termination. There's no single right answer to this question. Ultimately, it will depend on the specifics of the deal. And the next key issue in these types of deals is around agency. In a customer-facing SaaS deal, the provider has or may have some marketing, promotional, reselling type responsibilities that go beyond simply operating the platform, which is often the case in a back office deal. So there should be clear rules that define what the provider can and can't do on your behalf. For example, the authority to bind the company to any contract should not be granted except as expressly permitted in the agreement. In order to kind of simplify this administratively, you may want to have operational attachments that address these detailed topics, and that these might cover pre-approved operating territories, pre-approved marketing channels, pre-approved publicity statements that help operationalize these issues without having to get administrative approval over every instance. And the final issue I wanted to discuss on this topic is liability. So far, there really are no clear market standards for liability terms for customer-facing SaaS deals. However, it's worth pointing out that the logic behind market standard liability terms for back office deals may not apply as neatly for customer-facing deals. For example, back office vendors often argue that they shouldn't be liable for indirect damages. As Brad pointed out, this is often an exclusion. So for something like lost profits that result from a breach of contract, that would typically be excluded in a back office SaaS deal. The logic being that the services are delivered to your company, not to your customers, and the downstream effect on your company's profits, is an indirect damage in this scenario. But what if the platform is delivering services directly to the customer? If the provider fails to deliver those services to the customer, the resulting lost profits may actually be considered direct damages under certain state laws like New York. So, at the end of the day, in some deals, liability provisions are similar to back office SaaS agreements. In other deals, we've seen clients take very different approaches. The overall point being that you should not simply apply standard SaaS agreement approaches to liability without giving it at least some closer consideration. And one point on indemnities here at the end: if the provider is selling their own products to your customers, consider getting an indemnity from the provider for any resulting claims. And finally, in a customer-facing deal, you may also want to control the defense of any claims that are brought by your customers and regulators against the SaaS provider that you're obligated to indemnify, or otherwise. And with that, I'd like to hand it over to Lei to discuss privacy and security issues associated with SaaS agreements and SaaS deals.
Thanks, Rohit. So now we'll cover what data privacy and security issues you should consider when contracting for SaaS. And we'll start with the key data privacy considerations. Now, the most important question to ask to determine what data privacy considerations even exist is to find out what kinds of data the SaaS provider will be processing for you. or what kinds of data you'll be storing with the SaaS provider. And then based on that, you can determine what data privacy laws are applicable to that data, and then what requirements and restrictions actually apply. And this is where a brief overview of how U.S. and EU privacy laws regulate personal data might be helpful. So typically, privacy laws in the U.S. tend to be sectoral or focus on the type of data that you have. So for example, if you're in the financial industry, then you'll be subject to the GLBA or Gramm-Leach-Bliley Act. If you're in the healthcare industry, then you're subject to HIPAA. An example of a type of law that focuses on the type of data that you collect is COPPA, or the Children's Online Privacy Protection Act, which applies to you if you're collecting information from children under the age of 13 online. And these are all examples of some federal level laws. The U.S. also has some state privacy laws, and they typically are also sectoral or focus on the type of data that you have. So for example, all 50 states now have data breach notification laws, and these laws tend to focus on the more sensitive types of personal data, such as social security numbers or financial account information, or other types of information that might put an individual at risk for identity theft. Although a number of states have started expanding the types of data that are covered to include other types of data, such as a username and password. Now, the EU, on the other hand, has the General Data Protection Regulation, or the GDPR, which is an overarching or omnibus data protection law that applies to all businesses, so it's not sector-specific. It also has a very broad definition of personal information, unlike, for example, the state data breach notification laws that only focus on specific types. Now, the new California Data Privacy Law, of course, completely deviates from this structure. The California Consumer Privacy Act, or the CCPA, was inspired by the GDPR, and therefore it looks more like the EU structure of having an overarching or omnibus data privacy law, rather than the typical U.S. structure of having sector-based laws. So the CCPA is not sector-specific. It applies to many for-profit companies as long as they meet certain thresholds. It also has a very broad definition of personal information that's arguably even broader than the corresponding definition under the GDPR. So it's not confined to the typically narrow definitions of personal data that you typically see in U.S. data privacy laws. And a number of states have either proposed or even passed their own CCPA-like laws. So as a result, the U.S. has quite a range of definitions of personal data, ranging from the very narrow to the very broad. Now, this structure is important to keep in mind as you think about what types of data the SaaS provider will be processing on your behalf, and therefore what data privacy laws are applicable to that data, and what requirements and restrictions will apply. So for example, if the SaaS provider will be processing EU personal data on your behalf, then the EU GDPR will likely apply, and you'll need to consider the many obligations that you'll need to impose on the provider as a result. If the SaaS provider is processing any personal data that's subject to state data breach notification laws, such as social security numbers or financial account information, then you'll want to make sure that the data breach notification obligations are included in your contract and that you impose certain security requirements as well. And if there's going to be other regulated data involved, such as financial data or health data, you'll want to consider the requirements of the applicable sectoral laws, such as GLBA and HIPAA, as well as other laws that might cover those types of data, such as data breach notification laws. And these are just a few examples of some of the types of data that you'll need to consider and how different requirements attach based on the type of data that the SaaS provider will be processing. The next question you'll want to ask is where the SaaS provider will be storing, accessing, and transferring the data. This is important because the data that the SaaS provider may be processing may have certain data transfer restrictions that are attached to them. So depending on the restrictions applicable to the data, you might need to restrict where your SaaS provider is able to store the data, or from which locations they're able to access the data, and whether or where they are permitted to even transfer the data. So for example, if the SaaS provider will be processing personal data that's subject to the GDPR, or even one of the other GDPR-like laws, such as the Brazil's new LGPD, then data transfer restrictions will apply. And that means you won't be able to transfer that data to a jurisdiction that the country considers to have inadequate data protection laws without having other data transfer or adequacy mechanisms in place. So if you're in the EU and you're using a SaaS provider in the US, for example, you'll want to make sure that provider will enter into the EU standard contractual clauses with you, or that it has some other adequacy mechanism in place, such as being Privacy Shield certified. That personal data might also be subject to data localization requirements. So, for example, Russia and China both have data localization restrictions, which prohibit the data from leaving the country without having certain requirements being met. And in those instances, you might want to consider having the SaaS provider be able to store your data in the applicable country. Some laws also consider remote access to the data from another country to be a transfer of data to that country. So, for example, if an IT person is in another country and is remotely accessing the data, that might be considered a data transfer. So if that's a concern, you might want to put restrictions on the provider's ability to remotely access the data, or at least limit the countries from which they can do that from. Another question you'll want to consider is how the SaaS provider will be using or processing the data. Now, Brad and Rohit both discussed some considerations regarding data use earlier, but there are data privacy considerations here as well. Most companies don't want their providers to be able to use their data for purposes other than providing the services to that company, but some laws are starting to require this as well. So, for example, the GDPR requires service providers to only process personal data for certain limited purposes and only on the documented instructions from the data controller. And the new CCPA also has similar restrictions and requires that service providers not use the personal data for a commercial purpose other than providing the service to the business. So you'll also want to consider any use restrictions that may have been promised when the data was collected. For example, the user may have only consented to certain uses of the data, or your privacy policy might limit how you're going to use or share that data that are contrary to how your provider wants to use it. And finally, some providers insist on being able to use your data for their own purposes. Sometimes it's more innocuous, such as using it for data security purposes. However, sometimes providers want to use your data for more commercial purposes, such as creating benchmarking reports that use your data that then they sell to their other customers. Now, this can be an issue under certain laws, including the GDPR and more recently, the CCPA. And as I mentioned earlier, the CCPA does require that service providers not use the data for any commercial purpose other than providing the services. So the business does allow a service provider to use this data for other commercial purposes, such as creating these benchmarking reports. Then because the definition of sale is so broad under the CCPA, this might be considered a sale of the data to the service provider. Now, the CCPA's definition of sale is much broader than what we typically think of as a sale. Specifically, it defines a sale as selling, renting, releasing, disclosing, disseminating, making available, transferring, or otherwise communicating orally, in writing, or by electronic or other means a consumer's personal information by the business to another business or a third party for monetary or other valuable consideration. So as a result, if you do permit the service provider to use the data for other commercial purposes and such transfer falls within the CCPA's definition of a sale, you'll need to consider other obligations under the CCPA applicable to a sale of that data, including permitting a consumer to opt out of that sale of data to your service provider, and also including a link that says, "Do not sell my data" on your web page. You'll also want to consider how the SaaS provider will be returning or destroying the data upon termination of the services. And again, as with the use restrictions that we just discussed, most companies will want to have providers return or destroy that data upon termination of the services. But a number of data privacy laws also require providers to return or destroy data upon completion of the services. So this is something you'll want to keep in mind. So, for example, the GDPR requires a processor to return or delete a controller's data at the controller's option at the end of the services. And the CCPA also prohibits a service provider from retaining the data for purposes unrelated to the provision of the services. Sometimes returning or deleting the data isn't enough, though. So if you have data that's subject to data disposal laws, you'll want to make sure the provider is able to securely delete the data in accordance with those laws. So, for example, Ohio requires that companies destroy documents containing personal information by shredding, erasing, or otherwise modifying the personal information in the documents to make the information unreadable or undecipherable through any means. You might also want to require the provider to follow certain industry guidelines when deleting the data, such as NIST 800-88, which are the NIST guidelines for media sanitization. Finally, you'll want to consider if the SaaS provider will be subcontracting any of that data processing. If it will be subcontracting any of the data processing, a number of data protection laws do have specific requirements for processors regarding their subcontractors. So you'll want to impose these requirements on your processors, and you might even want to consider doing so even if your data is not subject to these laws. Just in the interest of time, I'm going to speed through some of these slides here. Now we'll look at some data security questions that you should also consider. The first question is similar to what we discussed for data privacy. Specifically, you'll need to figure out what types of data the SaaS provider will be processing so you can determine what data security laws actually apply to that data. So, as with data privacy, many types of data have data security requirements attached to them. And if you're processing any regulated data, such as the ones that are shown here, you'll need to make sure that you have appropriate security requirements in your agreement with your SaaS provider. So, for example, a number of state laws require that reasonable and appropriate security be used to protect certain data. And a lot of times, the requirements to protect the data from unauthorized access, acquisition, destruction, use, modification, or disclosure. The GDPR also requires processors to implement appropriate technical and organizational measures to ensure a level of security appropriate to the risk. And there's a number of other laws that require specific security requirements for your processors. Another reason you might want to consider data security requirements, though, even if it's not specifically required by law, is because a lot of states are actually starting to provide a safe harbor for meeting certain security requirements so that you have an affirmative defense to any cause of action that alleges failure to implement reasonable information security controls that resulted in a data breach. Ohio is one of those states, and it defies compliance with the NIST cybersecurity framework, FedRAMP, the ISO 27000 family of standards, among other standards to be considered meeting those minimum security requirements. So you might want to consider having your provider meet those same requirements if they're going to be processing data on your behalf and you want to take advantage of the safe harbor. You'll also want to determine if any of your data is subject to data breach notification laws, and then find out what the SaaS provider is willing to agree to in terms of data breach notification. And among the things that you'll want to consider for data breach notification are the scope of notification. Is the provider only notifying you of a breach of certain personal data, or is it notifying you of a breach of any data that's stored with them, even if it's not personal data? Are they notifying you only of confirmed breaches, or are they notifying you of reasonably suspected breaches as well? And this is important because most data breach notification laws actually require notification of those confirmed breaches as well as breaches that are reasonably believed to have occurred. How quickly is the provider going to notify you of the breach? The GDPR requires processors to notify controllers of a data breach without undue delay, but for these vague timeframes, you might want to include a specific timeframe as well so that you're not relying on the provider's interpretation of what undue delay means. And note that a number of state data breach notification laws also include specific timeframes for a provider to notify a data owner of a breach. You'll also want to determine what information the provider is going to provide you when it notifies you of a breach. Is it only providing you with limited information, or is it providing you with enough information to allow you to meet your various notification obligations? Cooperation. Is the provider going to cooperate with you in the event of a breach? So this could range from simply providing necessary information to assisting with notices or assisting in litigation. And finally, liability. What liability is the provider willing to accept for data breach, especially if they caused the breach? This was an issue with data breaches before with all the class action lawsuits that resulted, but now it's even more of an issue with potential fines that are involved with the new laws, such as the GDPR and also the private right of action under the CCPA. And finally, you'll also want to find out what data safeguards and protocols the provider will apply to that data, and also what audit rights that you have. So you might want to require specific, that the provider meet specific safeguards so that you can take advantage of the safe harbor that we discussed earlier. You might want to require the provider encrypt the data or have other safety mechanisms in place so that you can take advantage of some of the exclusions in state data breach notification laws. And you also want to make sure you have adequate audit rights so that you can actually make sure your provider is meeting its security obligations. And as we mentioned earlier, a number of laws actually do require you to conduct periodic assessments of your providers or oversee your providers to make sure their practices are actually adequate.
Thank you, Leigh. And with that, that wraps up today's program. And on behalf of Mayor Brown and my colleagues, thank you for your time. We do hope that you found this program useful. If you have any questions, please feel free to send us email messages, or while the app is still open, send a question. Some final housekeeping items. First, a recording and a link to the materials from this program will be distributed by email in the next day or two. To submit topic ideas or receive invitations to future programs, please email us at techtransactions@mayorbrown.com. Thank you again for participating. This concludes our webinar.